This is a story about privacy, specifically the privacy of keeping a company's ownership and operations out of the public domain. It seems like every day we hear about another so-called unicorn, a private company valued at over $1 billion. It's not just the number, it's the size and how long they've maintained their privacy.
I'm in no rush to go public. Public is, I guess, a way to, potentially make more money, but at the expense of a lot of public company overhead and inevitably a whole bunch of lawsuits, which are very annoying.
There seems to be broad agreement that more early-stage companies are in no great hurry to go public.
It's roughly that it used to take 7 years and now it takes 11. So that's a big change, and that doesn't count, obviously, the companies that failed and didn't get to go public.
There's no doubt that many companies now are staying, private more than 10 years even, which used to be the typical, maximum time they would stay private.
This reluctance to rush into the public markets has meant we've seen an explosion in the number of so-called unicorns, private companies reaching valuations of $1 billion or more. According to PitchBook, we've gone from virtually no unicorns in 2010 to over 1,400 today, worth over $5 trillion combined. The reasons are straightforward. First of all, being a public company can be expensive and just a pain in the neck.
I have several friends who are CEOs of public companies. The worst part of their life is the week before earnings day or the week after earnings day. It's incredibly painful, expensive to have a public company.
Jonathan Foster is president and CEO of Angelus Wealth Management, advising high net worth individuals on their investments.
There's not a public company alive that doesn't pay at least $5 million and up for being public, and that would be for a microcap, right? So you imagine what the large companies are paying, and the scrutiny that you have from the public market.
It's not just the cost and hassle that can discourage growth companies from going public. Gordon Phillips is a professor at Dartmouth's Tuck School of Business who has studied the reasons behind the decision to stay private.
When you go public, you release a lot of information, so there's sometimes proprietary information that you don't want to convey.
Does that drive the impetus to stay private longer, in part because you can't necessarily patent the relationship between what you know
Correct.
and what the capital provides?
Right, I think it does. I think then you're waiting, David, to go public until you've established a brand name that's well recognized. You can think of Uber and Lyft. They wanted to wait to go public until there was enough consumers signed up.
And then there's perhaps the biggest reason that large, successful tech companies stay private for longer, simply because they can.
One of the reasons is because of the availability of private capital and the venture capital money and growth equity money that's available. So there's tons of money, so you can get a lot of money from private capital. You don't need to go to the public market as quickly.
But not all private companies are created equal, and most of them are certainly not unicorns.
They're not your typical private company. I think when most people, and regulators and others historically, have thought of private companies, they've historically thought of a family company or a small business or something along those lines. The companies that you're talking about are nothing like that. Those are real companies that are operating on a global scale.
Sarah Keohane Williamson is the CEO of FCLT Global and author of the new book, The CEO's Guide to the Investment Galaxy.
What's interesting about private markets is that the ultimate owner sets the price. So if you think about in private markets, who actually, if a company goes private, for example, whoever pays for that sort of sets the price, and then that's what the price is. In public markets, the marginal trader sets the price. So the price changes every day, every minute, perhaps. And so I think that one of the really important differences is how good are the valuations on different sides. And so you mentioned some of the companies that are valued very highly. And those may be very accurate valuations, but a lot of times the difference is between a mark and an actual trade.
Being a public company has its share of costs and disadvantages, but staying private has its own drawbacks. Professor Phillips has compared some similarly situated companies that have gone public with those that have not.
In a research paper, we looked at companies which went public, and then we looked at companies which pulled their IPO. They filed to go public, and then they decided, hey, the price isn't good enough. I'm gonna walk back. So we look at those who filed. They both had the incidents, and we found those that went, they still got substantial benefits The benefits are the liquidity we talked about, but really the second benefit also is acquisition currency. When you're public, you can actually buy other companies with stock, and you don't need necessarily cash to make that purchase or debt. One example is, Apple has done lots of acquisitions, including Beats by Dr. Dre. They bought that back a while back, and they paid $2 billion, but it was, again, they had enough cash and shares that they could easily make that purchase, even though it was $2 billion.
Having publicly traded stock also allows management to give incentives to employees through stock options and similar compensation arrangements.
A lot of times is the employees want to be able to sell. Now, there are some private internal markets that have developed to allow employees to cash out before they go public. However, those markets are not as liquid, maybe the prices aren't as good.
There are also some benefits in going public that can't be measured.
There is credibility to being a public company, whether that is to suppliers or other business partners or employees or others. And then I think it really opens up all of these opportunities, like issuing more stock to purchase companies. It just opens up a whole new world. So there are very good reasons for companies to go public, and that's why many do still.
But what does it all mean for the rest of us, for those of us not lucky enough to get in on the ground floor? First of all, it means that there are just fewer public companies for us to invest in.
25 years ago, there were north of 7,000 public companies, maybe 8,000 public companies. Now there are only 4,000 public companies. So there's been a real shrinkage of opportunities to invest in equities in public markets.
And then there's the prospect that by the time those big growth companies go public, they've already realized their explosive growth.
When Apple went public, it only had like one round of venture capital. People went and bought Apple stock. You got to participate in all the upside as the stock was rising in the public markets. If you're going public and it's already worth, $100 billion at the time of the IPO, or 20 billion, whatever the number is, still a big number already, then you've already baked in a lot of the gains, and so the gains don't get distributed as much broadly to the, to the population. Retail investors are not getting that period of heady growth at the beginning. Now we're seeing, OpenAI staying private, and they're going to be pretty big, and then, other companies like SpaceX, again, staying private. You can't yet participate until they go public as a retail investor.
The pendulum has definitely swung toward companies maintaining their privacy for longer, or even indefinitely. But as so often happens in the markets, what looks like a long-term trend may turn out to be more of a cycle, in no small part because coming into the sunlight over time has given investors some pretty favorable returns.
I asked ChatGPT a great question a few weeks ago. What is the relative return between putting $1 million into residential real estate on an unleveraged basis in zip code 90049? So that's, in Los Angeles, which is where I happen to have a home, and that's been one of the great residential markets in America. I said, doing that versus $1 million in the stock market from 1960 to today. And it took it like a minute to figure it out. And it said, if you put $1 million in the residential real estate unlevered in that zip code in 1960, it's worth $7.7 million today. And in the S&P 500 with dividends reinvested, it's worth $1.1 billion. The public markets are great over a long-term basis. So I think people should not feel they're being left out.
The biggest consideration of all might be the value of public companies to the depth of the capital markets.
Well, if you look at economic history, you will see that the most vibrant economies over time have had a vibrant public market. So I think there is public value in vibrant public markets. And of course, that's where we come back to this level playing field argument, which is it used to be 10 or 20 years ago that a regular retail individual, just a regular citizen, would be very unlikely to have much exposure to the private markets. But today, because there's such a large portion of pension plans, defined benefit plans in particular, and other investment vehicles, individuals do have a lot of exposure to private markets if they are a participant in a pension plan.
With all the pluses and minuses of going public or staying private, in the end it comes down to more than just capital structure and protecting your trade secrets and incentive compensation.
So I think as a business leader, the question is really what kind of company do you want to be, as much as what kind of capital do you want to get. The best company leaders think about their investor strategy just like they think about a customer strategy. So if you ask a CEO what their customer strategy is, you can almost always get a very clear answer about what kind of customer they're targeting, in what location, why. If you ask a lot of leaders what is their investor strategy, you don't get nearly as clear an answer. And it's really important to have that kind of clarity because those investors will end up dictating or at least nudging the company in certain directions, whether it be shorter term or longer term. So have an investor strategy that's just as robust as a customer strategy.